Good morning, everyone, and thank you for joining us for today's quarterly market investment update. This webinar is being hosted by Counselor Buchanan and Mitchell and May Barnhart Investments, CBM's fee-only wealth management subsidiary. And our presenters today are Seleznev and Josh Hahn. In a minute, I'll be reading their bios, but just to provide a broad overview, Josh and Alex have many years of combined experience monitoring the markets, looking at the impacts of external events, and working with clients to help them understand what the possible impact is of external events, helping them with financial decision-making behaviors. So if you're a client of MBI already, you're already familiar with this, you know the great work that they do. If you're not a client, this webinar is essentially meant to give you an idea about how they help clients, how they, kind of evaluate the markets and the impact on, your life savings, essentially. In addition to these webinars, we also provide a quarterly market commentary. And Alex, just confirm if I'm wrong, but I think MBI's quarterly market commentary went out the other day. We offer one for CBM as well if you're not an MBI client, so that will be going out soon as well. It's one of the ways that we help clients and non-clients. So we'd love the opportunity to get to know you better. We welcome you to today's webinar. If you do have questions at any point in time over the next hour, so please do leave them in the chat box. For those of you who submitted questions during the registration process, thank you so much. They've been shared with Alex and Josh, and they've incorporated responses into their presentation. So after today's event, tomorrow most likely, we'll be sending out a copy of the slides from today's presentation. We are recording today, so you'll also get a link to the recording. And before I introduce our speakers again with a bio for each one of them, I'm also going to be leaving in the chat box an evaluation link, probably about 45 minutes in. So if you wouldn't mind taking a moment or two to just provide some feedback on today's session, we don't require your name, it can be anonymous. We really are just looking for some honest, frank feedback. Would love to hear your thoughts on today's session. So let me just quickly read through Alex and Josh's bio, and then I'm going to turn it over to our speakers. So Alex is a partner and a director of wealth management and financial planning services at CBM, and he is a co-founder and the chief investment officer at MBI. Alex is a certified financial planner and a chartered financial analyst. He has 15 years of experience providing comprehensive financial planning and investment advisory services. Alex specifically focuses on pre- and post-retirement planning and helps individuals and families avoid market downturns and protect their life savings. He regularly presents for CBM, including at a recent quarterly market update webinar. That's the first one we did this year, and in a recent session on demystifying Medicare. Alex is also scheduled to co-present during an upcoming May 2nd webinar on the new Secure 2.0 legislation. Finally, Alex was recognized recently as a top financial advisor by Bethesda Magazine, and he's frequently quoted in financial media outlets such as Kiplinger. Josh Hahn, he is a senior investment analyst with MBI. He has nearly 10 years of financial service expertise, including in the areas of fixed income, alternative assets, and consulting for institutional and private clients, and asset liability modeling. Josh works with clients to review their portfolio risks and performance outcomes set against benchmarks. He analyzes model equity and fixed income funds for client portfolios, and he assists in other areas of financial planning. Welcome one more time to today's session, and I will turn this over now to our presenters.
Thank you, Joe, and as always, thank you everyone for joining us today. And I was just actually looking at the list of participants. We are expecting to have a good group today, actually one of the largest number of participants, at least so far this year. And it's interesting, every time I look at it, roughly half of the names on the list are people that I know personally, many of them are our clients, and the other half are new names. So of course, welcome to both groups. But for those, again, who are less familiar with what we do, well, our group is a subsidiary of CBM. We focus on comprehensive financial planning and investment advisory work. On the financial planning side, we can help you with your cash flow, estate planning, college planning, retirement planning is, of course, a big part of what we do. Our specialty is actually on pre and post retirement planning. And on the investment management side, the idea is to ensure that the investment policy you have in place matches your financial plan, which is really key. If you're interested in learning more, feel free to visit our website on the bottom of the slide, or of course, reach out to Josh or myself. With that, let's get started. Again, for those of you who participate in our quarterly market update, we try to start with something, funny, with a little bit of humor, and I hope at least some of them will find this to be somewhat humorous. So, of course, the banking issues that we've been experiencing over the past couple of months, well, in some sense, and we'll talk about that more certainly, perhaps they've been blown out of proportion somewhat. And even the term financial crisis or banking crisis, anytime people, put it that way, usually the reference is to 2008 and 2009, and it's not even close. I mean, yes, we have some bad apples there, and perhaps there are some other smaller regional banks that are going to experience some trouble, but industry-wide, again, it's not even close to what we had 15 years ago at this point. And again, we'll focus on that more in our webinar today. In terms of our format, as always, we'll update everyone on what's been happening in the markets over the past 3 months or so. We will share our market outlook going forward, and we'll certainly discuss some of our top investment ideas, again, usually for the next couple of quarters. So I'll start by saying that, again, given the market volatility since the beginning of the year, which is certainly not as prevalent as last year. As of the day before yesterday, the S&P 500 index was up by 8%, which is again one of the main benchmarks for domestic stocks. More growth-oriented stocks that are measured by the NASDAQ index actually up by 16%. So they're recovering by quite a bit. Small cap stocks are up by 3.5% or so. And what's interesting about small caps, they performed very well in January of this year. I even remember noticing that in our previous market update, they were up by almost 12 percentage points, but then, and given the banking issues and other economic updates, they went down. And that in some sense just gives you a taste of how smaller stocks work. They can rapidly go up or down. Now, developed international stocks, in terms of major indices, they are the best performing asset class year to date. They're up by 11%. We talked about it in a previous commentary, and we'll certainly focus on that more today. Emerging markets are doing reasonably well. They're up by 5% or so. Josh will dissect that for you more, but again, they're recovering. And finally, domestic bonds, as measured by the Barclays Aggregate Bond Index, are recovering, but perhaps the recovery has been somewhat sluggish. They were down by 13% last year. This year, the index is up by roughly 2 percentage points. And by the way, perhaps one of the main reasons is investors are still anticipating additional rate hikes. In terms of the 10-year Treasury yield, which is, I like to refer to it as the market's interest rate, we finished the year, just as a reminder, at 3.88. At the end of last quarter, we're at 3.4, similar to that at this point. So in some sense, not much changed, even though, again, there's been quite a bit of market volatility. In terms of the sector performance, in some sense, no surprise. Communication services, technology, consumer discretionary stocks are leading the way. Those sectors are up by double-digit percentages. Again, as a reminder, they were down anywhere between 30 to 40% last year. So we're certainly seeing that recovery year to date. More conservative sectors such as utilities, energy, I'm not sure if necessarily calling it more conservative is the best way. And then, financial services, including banking, are in the negative. In terms of financial services, by the way, that category was down by as much as 15% just a month ago or so. So those stocks have been recovering as well. In terms of the market outlook, so some of the things that we've been focusing on, or just a couple of things to point out, of course, the turmoil in the banking industry is on everyone's mind. I'm inclined to say that at least as we speak today, those issues have been contained. I'm not saying that they've been resolved. And what's interesting, when we follow the industry, even on our end, we do tend to focus on the largest financial institutions in the US, usually the top 15 banks. And perhaps as some of you know, they have to pass the so-called stress tests semi-annually, if I'm not mistaken. Otherwise, they wouldn't be able to increase their dividend payments. So from that perspective, they appear to be safe. But of course, there are thousands of different banks in the US, and specifically when you start focusing the bottom quartile, well, perhaps we'll hear of more issues going forward. The so-called mega cap stocks. And I don't necessarily want to mention any names here, but you know what they are. These are the largest, usually tech companies in the US. They've been recovering very nicely since the beginning of the year by double-digit percentages. So that's certainly a positive. And since they're on the growth side, well, those investors who focusing on growth-oriented stocks certainly benefited from that. International stocks, that again was one of our best ideas that we shared in our previous quarterly market update. They've been performing really well. Again, last year they were really underpriced from our perspective. Some even referred to them as dead money at the time. Then of course the energy crisis in Europe turned out to be not such a big deal as many people were expecting. And with the currency exchange rates, with the US dollar weakening over the past 6 to 9 months, that also creates a tailwind for international stocks. In terms of the Fed policy, well, at this point, we are expecting one additional rate hike by 0.25%. I actually went to a conference yesterday, and that was one of the questions that was discussed. And what was surprising, usually you expect to hear many opinions on the issue. Every single person that I asked expects one more rate hike this quarter, 0.25% essentially. Some are expecting rates to go down closer to the end of the year, but be careful what you wish for. If that actually happens, well, perhaps that would indicate that the economy is not doing all that well, so the Fed would perhaps try to stimulate it more. But at least from our perspective, we're not necessarily expecting that, at least not yet. In terms of the earnings expectations, we're in the very beginning of the Q1 earnings season. Banks are usually, well, not usually, they're always the ones that report first. And so far, the results have been mostly positive. So some of the bank stocks, larger banks specifically, they've been rallying since the beginning of the quarter. In terms of the estimates, they are in a negative, and analysts been adjusting them down over the past number of, I'm going to say years at this point, actually, or at least quarters. So that just tells you that a lot of that has already been priced in, perhaps. The only question is how much. In terms of the projected rate of return, and again, I always say this, I'm not a big fan of this short-term prognostication, but at least in terms of what I've been reading, anywhere between 6 to 13% for the year. Again, most people that I know, at least personally or analysts, are expecting 2023 to be a positive year. Of course, keep in mind the markets are already up by 8% or so as we speak today. In terms of the economic conditions, well, interesting. There's really not much to report in terms of the changes over the past 3 months or so. The unemployment rates, which is of course one of the most important indicators, remain steady / low. The unemployment rate in the US is at 3.5%. It was at 3.4 in the prior month, but again, that just doesn't make that much of a difference, all things considered. Inflation has been declining. We're currently at 5%. If you want to be precise, it's actually at 4.98%, the consumer price index metric. Previously, it was at 6.04, so that's a 1% lower. In terms of the expectations, again, based on what we're seeing here, and again, how aggressive the Fed policy was last year, 7 rate hikes, and 4 out of 7 were by 0.75%. I do believe we're on track. So perhaps closer to the end of the year, inflation will be anywhere between 3 to 4%, unless, again, something drastic happens. I've heard some opinions that it will drop below 3. And again, is that possible? Perhaps, but that would usually indicate that, again, the economy is really declining. So, be careful what you wish for. And in terms of the potential Fed policy pivot, and again, that's when they would change their outlook or their goals in terms of the interest rate policy. Perhaps that's going to happen again this summer. Again, we're expecting one more rate hike, and perhaps there's going to be a pause for the rest of the year. Now, for those of you who like to see different charts, well, this is what the CPI report looks like in the form of a graph. Again, notice that inflation peaked here in June. That's right, in June of 2022, it was at more than 9%, and since then it's been gradually declining to 5% as of today. Notice that again, prior to 2021, it was very consistently at 2% or so. Asset class return quilt. Again, this is one of my favorite charts to discuss. Again, for those of you perhaps less familiar, essentially we're showing you the performance of each major category, major asset class each year from 2012 all the way to year to date. That's of course a partial year. And then we summarize it for you on the very right. So in terms of the year to date performance results, notice that again, developed markets have been outperforming everything else, and specifically European markets are doing really well. Large cap stocks are the best asset class in terms of the domestic stocks. Emerging market stocks are also doing well, and again, Josh will touch on that more. And balanced portfolios, again, they're usually considered to be 60% stocks and 40% bonds, some sense as expected, are somewhere in the middle. Now I'll touch on that separately. Now I'll skip the other four here. Notice that commodities are in the bottom of this table, of this list. And that in some sense is not surprising. And again, there's a reason why we highlighted commodities in yellow. They performed really well in 2021 and 2022 when inflation was high or was expecting to go up. And with commodities specifically, they tend to be very cyclical in nature, those types of investments. They also tend to perform relatively poorly when inflation is either declining or expected to decline. So keep that in mind. In our previous quarterly market update, we mentioned that if you invested or you decided to overweight commodity-like investments in your portfolio, perhaps it would be a good time for you to take some gains off the table. Well, we still believe so, even though, by the way, with oil prices, they've been going up, as perhaps many of you noticed over the past few weeks or so. Domestic stocks, performance of domestic stocks since the beginning of the year. Again, I very much enjoy discussing this with our clients in our semi-annual meetings, because again, it kind of gives you a good picture of what is happening under the hood, or behind the scenes, whichever way you want to look at it. So notice again in 2022, I understand this is old news, the markets were down by 19%, but the growth category, again, these are your large cap growth stocks, again, those bigger names like Microsoft, like Apple, and again, the category as a whole were down by 36%. Large caps were down by 40%. Notice that year to date, it's essentially the opposite of that. Large cap growth stocks are up by, getting closer to 18%. Growth category overall is up by, more than 14 percentage points. So not necessarily half of the losses from last year, but let's say roughly 40% or so. And again, it just shows you how quickly things can actually begin to recover. Notice on the value side, so this are again more mature, usually more dividend-paying stocks, they performed relatively well last year. They were essentially flat, but also notice that this year, they're also not necessarily doing all that much. They're flat for the year as well. And said this earlier, and I'll say this again, when someone asks me, is this a good time to invest in the market? Right, and I get that question quite frequently. Usually I try to stay away from that because it's, we're not trying to time the market. But if you decide to invest, you don't have to invest literally in the market as a whole. You can always adjust it based on your preferences. If you like to see more growth in your portfolio, perhaps you would focus more on growth-oriented stocks and vice versa. If you're looking for more dividend income and stability, then perhaps value stocks are a better choice for you. In terms of the market outlook, these are some of the things that we'll be focusing on and discussing internally over the next quarter or so. Of course, in terms of the financial services or banking industry, to be specific, I'm sure there'll be other updates. Personally, I look forward, let's put it that way, to the report that will be released by the Fed on May 1st. They are in the process of probing SVB's internal policies and exactly, what happened, without necessarily sharing too much. Again, the report will come out on May 1st, but there are many yellow flags that were known last year, specifically in the fourth quarter of last year, and for some reason, no action was taken. So hopefully on May 1st, we'll find out why. Now, the so-called balanced portfolio, or usually you'd refer to it as a 60-40 allocation. Some strategists declared it to be dead last year. So is this true? And to say it differently, does it still make sense to have bonds as a buffer portion of your portfolio? We'll discuss that separately. Emerging markets, of course, they're in a lot of diversified portfolios, but exactly what are they, and Josh will talk about that separately. And then finally, one of the focus areas over the past 3 to 6 months at this point is on fixed income, specifically for those of our clients who are in their pre or post-retirement years. Is this a good time to invest in bonds? Well, my short answer is yes. The yields are much higher versus where they were, 12, 15 months ago. But is this a good time to diversify your fixed income holdings? And this is not to say that you should be keeping all of your, bond eggs in one basket. But at this point, from our perspective at least, treasury bonds are the best choice versus corporate bonds and even municipal bonds for most people. Of course, if your circumstances are different, the recommendation for you can be quite different. Josh, what do you have for us?
Alex, thank you. Can you hear me?
Yes.
All right. So, as Alex mentioned, next we're going to cover some of the recent happenings in the financial services industry and specifically banking. Understandably, we've had quite a few questions surrounding these recent bank failures. And because of these failures, the stock market as a whole has declined, and especially the financial services sector has underperformed, and bonds reacted in a similar fashion. In a former life, just as a little background, I worked at an institutional portfolio, and we monitored what we called interest rate risk for a pretty big portfolio. And this is basically just fancy speak for saying we make sure what happened to SVB didn't happen to our financial institution, and we did it pretty successfully. So I think I have a pretty unique perspective on the situation as a whole. So to give a little summary on why SVB failed and what we know at this point, at some point a few months ago, word spread around to customers that there weren't going to be enough funds to withdraw from their accounts. It's a very tight-knit community that's not at every bank that allowed this to happen. A lot of their customers are in venture capital and know each other, or they work in the startups that the VCs invest in. So very tight-knit community. And I don't know if anyone's seen It's a Wonderful Life, but at one point there's a bank run and all the consumers rush to the bank to go to try to withdraw their money. And it didn't exactly happen like that because nowadays everyone has access to withdraw money from their phones and mobile apps and their browsers. So it's much more accessible and it can happen in a very brief period of time. So typically when banks take your money, they invest in very liquid securities. So think short-term treasury bills, for instance, but they also tend to invest in longer-term securities like a 10-year or more bond, or they might invest in everyone's favorite mortgage-backed securities, which can have durations of 20 to 22 years, so much longer term. And because rates rose so suddenly last year, the value of a lot of those long-term securities just dropped, and you couldn't sell them for what they were worth when you purchased them. You would have to take a loss. And when you sell them at that loss, they can't cover all the deposits in the bank, essentially, if everyone tried to withdraw their money at the same time, which is what happened. So if the bank can't pay its depositors up to what they're deposited into the bank, they're insured $250,000 by the FDIC. If you've physically been in a bank, you'll see big plaques everywhere that say FDIC insured for up to $250,000 to let the customers know that's how much it's going to be insured up to, or you might hear a commercial for a bank and it might say member FDIC. And that's why that's important, right? Because if your deposits are at the bank, that's the only amount that they're insured up to, in theory. But when all of these losses kind of accumulated at SVB, the government stepped in to say, we're going to cover more than just the FDIC limit of 250. We think that this is isolated and we're going to cover that amount. And that's for the depositors only, so not necessarily equity holders. So if you had shares in Signature Bank, for example, the government didn't step in and say you'd be compensated. That's only the depositors. And then other banks got caught up in similar situations. Signature Bank was probably most notably similar. But the takeaway for most people that want to know is this just an isolated incident, or is this a more systemic incident? So I want to preface by saying that we can't know specifically, but in my opinion, there's a lot of things that point to this just being an isolated incident for these particular financial institutions. First and foremost, SVB Signature had very unique clients that had a lot of uninsured deposits. You'll see in the chart on the slides that are showing right now, these banks had a much larger proportion of assets that were not insured by the FDIC. A lot of these clients were startups that had maybe payroll at the bank in the tunes of millions of dollars, and they weren't insured by conventional methods. So if you're a small business and you need to do payroll, you have to keep it in a bank account. That could be potentially millions of dollars, right? And that's not something you're going to see a lot of community banks or community credit unions. So if this were to happen, you might have that backstop for your savings. And then the second major point is that they seemingly had very poor interest risk controls. And this is what Alex touched on earlier. And this is the area where I worked. I'm still trying to gauge why they were allowed to purchase so many securities with the longer durations. I think a lot of these companies, they have so many models. They have finance and interest rate committees that constantly talk about this stuff. There are tons of banking regulations, and they run simulations that say, what if interest rates increase 3% tomorrow? Or what if we lost 50% of our deposits in one day? Could we be solvent? And they're intentionally absurd situations that would likely never happen. But the point is to give management confidence that even if these absurd situations happened, they would still be solvent. Alex mentioned a report's going to come out soon, so I guess we'll see what the takeaway was. I've heard that why this didn't happen is because interest rate risk team kind of maybe fudged or manipulated the numbers to make it look better or to make the model less conservative, so to speak. And that's about as good of an explanation that I've heard. But like I said, I guess we'll find out in the coming days. If you're still concerned about this, there are some things that you can do to mitigate that risk, right? I know individuals that keep anything over $250,000 in multiple banks. That way the FDIC insurance covers your securities in multiple banks, or they just choose to bank with larger banks that they believe will be bailed out if, for instance, there was a failure at your bank. So, and that's all I got on that. We'll answer some questions later at the end of the presentation as well. I'm sure there are some, but we'll move on to emerging markets, which is a bit of a change up, but we have been getting a lot of questions been popping back into the conversation with our clients and hearing some questions about what are emerging markets, so to speak, and why is it different than other international funds that are in our portfolios, right? So emerging market basically refers to a whole host of countries that are not yet developed or were developed but regressed a little bit. So it could be Chile, Egypt, Poland, Korea. There's a whole list on the slide there. That being said, a lot of these funds aren't going to be situated in like United Arab Emirates, for instance, unless you buy a specialty one. A lot of them are situated in China, and Brazil and India are also big ones. in Russia used to be popular, but for reasons that are pretty obvious, that they're not as popular in emerging market funds anymore. You can purchase them in an EFT mutual fund, or you could just look for a target location. So, for instance, if you just wanted to buy in emerging market funds for India, then that's certainly an option. Or if you wanted to target just Asia, there might be a collection or a basket of Asian emerging market funds. So here's the good of emerging market funds is that they add some diversification to an international fund position in your portfolio. Typically, it's just a small part of your larger portfolio, but you might not want to be just invested in Europe, for instance, in case they underperform for the foreseeable future. There's a lot of location diversification that can be brought to your portfolio there. The not so good is that they seem to be somewhat volatile, and they have been over the past decade or so. If you look at the market quote that Alex covered, there were years where emerging markets is outperforming everything and years where they're dead last. And in addition to being volatile, they have underperformed as a whole over the last decade. They've had about 2% return, where something like domestic stocks are from 8 to 12%. So it's been a little bit underwhelming. It's also worth noting that this is a situation where a lot of times passive funds are beneficial because they're lower fees and they track the overall markets. But because they require such an expertise in some of these countries and emerging markets, it's an area where active management could have some potential benefits there. And that's all I got. Alex, let's switch back to you for more.
Thank you. Thank you, Josh. Yeah, emerging markets are interesting. I'll just say that there's been a lot of promise behind them, but in terms of the actual outcomes, I mean, that has not been the case. I mean, it's just, not to deviate too much, but even with some domestic stocks, specifically growth-oriented stocks, whereas an investor, you can't really do anything about the revenues of the company. It's all about the earnings. That's, as an investor, that's what you can, quote unquote, put in your pocket. And that, as Josh said, over the past decade or so, certainly has not been the case for emerging markets. Okay, so in terms of, again, I don't want to say it's been the most typical question over the past 3 to 6 months, but some clients and certainly across the financial media, people have been alluding to this. So the idea that the so-called balanced portfolio is dead, and what that really means is perhaps it doesn't provide as much protection as it used to in the past. So is this true or not? So again, perhaps for some of you who are less familiar, what is a 60-40 portfolio? What is a balanced portfolio? Well, usually they refer to a portfolio that consists of 60% stocks and 40% bonds as balanced. It's a trusty guidepost. Internally, by the way, we're neutral on it. We frequently use it as a benchmark for a moderately aggressive portfolio. But in practice, again, when you actually start investing in any kind of allocation, you of course have very many choices. So the 60% on the stock side can be more in dividend paying or more conservative stocks. And in terms of your bond allocation, of course, it would most likely make a very big difference if you focus on treasuries versus corporate bonds or anything else of that nature. So even then, again, the point I'm trying to make, balanced portfolio that, let's say, we're focusing on can be very different from someone else's allocation. Now, again, over the past number of decades, it's been seen as successful. And one of the main reasons behind that is because stocks and bonds are normally not correlated or not correlated as much. And to say that simply, when stocks go up, bonds are expected to go down or preferably stay flat. That's really the idea. And more importantly, vice versa. So when the markets are volatile, of course, stocks are expected to go down, and then bonds are expected to provide this, so-called buffer. That's how I refer to it. Now, that is certainly not what happened last year. Equities or stocks and bonds moved in lockstep. So of course, on the stock side, there are many recession concerns. Of course, the situation in Eastern Europe did not help, to say the least. With interest rates going up, like I said, 7 times, so created a lot of pressure on stocks. Now with bonds specifically, and this is again where people really need to understand the relationship, there's this very well documented inverse relationship between interest rates and bond prices. When interest rates go up, bond prices go down. It's not always as simple, but this is how it tends to work. Now, what is important about bonds versus stocks? Let's say you have a bond, you purchase it today and it has a maturity of 2 years, to make an example. Well, let's say you paid $1,000 for it. So up until the bond matures, well, the price will likely fluctuate. They don't necessarily stay flat in terms of their price. But at maturity, assuming of course the company doesn't go bankrupt, and let's say with the U.S. Treasuries, so let's say it's fair to make that assumption, you'll get your money back, you'll get your principal back, plus of course over this 2-year period, say you've been collecting your interest payments. So, but in any case, the performance of a typical, again, balanced portfolio was down by 17% in 2022. So the question, which I would say is a legitimate question, does this approach / allocation make sense going forward? Well, my short answer to that question is absolutely. And I'll start with statistics again. Over the past decades, this approach worked well. And when I say this approach, 60-40, same applies to 70% stocks and 30% bonds, 50% stocks, 50% bonds. And there are certainly periods, and we had them in the past, when both stocks and bonds were down at the same time. Perhaps not as much, because again, last year was truly unprecedented, and I will stop using this word at some point. I really need to stop, because again, interest rates went up so rapidly and so many times. Now, in terms of how we allocate for our clients, how we invest for our clients, again, on the bond side, imagine if you have at least 5 or 6 different options. You have shorter term bonds that are very much cash-like, and yes, they were down last year, but only by 1 or 2%. So for those of our clients who needed cash from their portfolio, monthly, quarterly, or any other basis, it was certainly there. We had some longer term bonds, that have maturities of 3 to 4 years. And yes, those bonds were down, but they're recovering and they're still paying, at the time was anywhere 3 to 4%. So you still get that income. In terms of where we are today, well, one of the top ideas that we've been implementing, not just exploring, is building so-called bond ladders. We have so many options at this point. Again, I checked this morning, a treasury that matures in less than 1 year pays 4.9%. I mean, that is quite attractive. So you can build a bond ladder, again, with shorter maturity. So you get your money back every 3, 6, maybe 9 months. And in the process, you earn, 5% or so. Now, the other piece, which is perhaps outside of this specific conversation, but regardless of what allocation you have, 60, 40, 80, 20, or anything else, we always recommend that our clients maintain anywhere between 3 to 6 months of their regular expenses in cash. And that certainly helps, and if you're more on the conservative side, it would most likely make sense to keep it anywhere between 6 to 9, or perhaps even 9 to 12 months. Again, at this point, we have access to money market accounts that pay 4.5% to 4.6%, if not more in some cases. So we certainly believe that this approach, with certain adjustments, still makes sense going forward. A little technical here. So what you're looking at is the correlation between the global bonds and global stocks here. That's the chart we were able to find for this webinar. So notice in the past, for many years, and if you go back, it would be somewhat similar. We used to experience more of a negative correlation between stocks and bonds. Again, that is why the idea of diversification works. But last year, that was certainly not the case. So, all right. So in terms of our top ideas at this point, and again, some of these were already implementing or in the process of implementing in our managed portfolios, and other ideas were simply entertaining at this point. So, and it's interesting, I just had a phone call with one of the clients earlier this morning. He's in his I want to say late 30s. And what's interesting, we had a conversation about the market volatility and everything, and I suggested that perhaps going forward he should begin to warm up to additional bond allocations. And why is that the case? Well, let's look at it from the absolute perspective. Let's say you have a plan, you developed a financial plan, and you need your portfolio to generate 6% in the long run, which is, by the way, one of our most common assumptions. If you're able to reasonably expect that the fixed income or bond portion of your portfolio can yield anywhere between 4 to 5% versus, again, 0 to 1%, 12 months ago, well, that means that you need to take less equity risk, or in other words, you don't necessarily need to put as much in stocks at this point. Now, same is true from the relative perspective. Again, for those of our clients who are usually in retirement and they need income from their portfolio, a year or two ago, we mostly focused on dividend-paying stocks, 3% yields, and yields, by the way, remained more or less the same. Now, with bonds, short-term bonds specifically, you're looking at yields of close to 5%. So it also makes sense from the relative perspective. Be prepared to consider longer-term bonds. That is something that actually Josh and I discussed in detail at the end of last year. And if/when interest rates normalize, and perhaps this will happen this summer, consider adding bonds with maturities of 2, 3, maybe even 4 years to improve yields in your portfolio. We're not quite there yet. Again, shorter-term bonds are the best value at this point. Eventual rotation from value to growth stocks, which is, perhaps the word eventual needs to be even removed at this point. That has been the case since the beginning of the year. So in terms of our internal allocations in those portfolios where we focused on dividend and dividend appreciation stocks, we certainly believe that they're less attractive today versus a year ago, 2 years ago. So we've been gradually rebalancing out of those categories. And then finally, again, international stocks specifically developed, I will say that they are some of the best performance year to date. And we do believe that overall valuations still remain attractive. We've been bringing them back to the targets in each client's investment policy over the past 3 months or so. We're not quite at a point where we want to overweight them. We're not quite there, but we still believe that they're a good choice compared to perhaps other categories. And with that, perfect. We have 18 minutes. Many questions before we do that. We have multiple, actually, really good events coming up. On May 2nd, we'll talk about the Secure Act 2.0 and specifically how it impacts those who are thinking about retirement or in retirement. That group will likely be affected the most. I'll have a webinar on post-retirement planning, top ideas and considerations for Capital Senior Solution. That's with Jan Brito. And we'll also have a webinar, about divorce and later in life. Also going to be discussing top planning ideas and mistakes to avoid. So a lot of good material tailored specifically to those groups. So keep that in mind if you're interested. Questions. So as always, we are going to address, we actually have quite a few questions that were submitted to us prior to this webinar, but please type your questions in the chat box. We will read them out loud, we'll address them, but we will not mention your name, of course, for privacy purposes. Josh, what do we have?
Yeah, like you said, we have quite a list here. We'll try to get through all of them, but there's quite a few. Let's start off with, what are the best investment portfolios now? Low risk, high yield. You want to start off, Alex?
Sure. Well, again, the answer to that question depends on your goals and objectives and your overall risk tolerance. If you're really looking for something that is low risk and higher yield, as I mentioned, treasuries, U.S. treasuries that have maturities of 1 year or less are likely to be one of the best choices. Again, they have yields of right around 5% at this point. So if that's what you're targeting, I would start there. Please do realize, if you decide to take that approach, that if/when interest rates normalize or perhaps even begin to decline, 2024, that's one option, the yields will also go down. So keep that in mind. Anything to add, Josh?
Yeah, that's treasuries have been very attractive recently. So that's the only thing I'll add. Low risk and high yield is usually don't go hand in hand, but it's hard to beat the interest rates on some of these short-term securities. So, all right. This next question just says markets and banks affected by recent changes.
Well, I'm happy to just comment on this. It's
Yeah.
not necessarily a question, more of a comment. So,
Right.
as I mentioned earlier in our webinar today, at least as we speak today, it appears that the situation has been contained. And in terms of the banking industry, again, on purpose, we didn't want to go into that in more detail. But in terms of the impacts, I'm inclined to say that larger banks will likely benefit from it. Yes, because again, in terms of their lending policies, they tend to be more stable and less aggressive because again, they're larger banks. They don't necessarily have to take all of those risks. So now in terms of the money flow, so as many customers and specifically entities are reevaluating their internal cash management processes. So I have a feeling that larger banks will likely benefit. Now, in terms of the markets overall, yet I'm inclined to say that a lot of that has already been priced in, which is what usually happens rather quickly. Yeah, so unless we learn something new again on May 1st, or perhaps some other banks report something negative, but at this point, yeah, that's my thinking.
Yep.
Josh, anything to add?
No. I think your point's on markets already pricing in a lot of these for a lot of different banks that aren't even affected by these, have been underperforming. So, we'll see if anything happens. But I like we mentioned before, if it's an isolated incident, then a lot of these are trading at a much lower level than they were a few months ago. All right. So this next question I thought was really interesting. There's much talk now about cybersecurity threats posed by TikTok and possible misuse of AI. Do you expect more regulation of the technology sector, and how will this affect stock prices? Great question. I expect regulation to occur, but kind of with an asterisk. With Congress split, any legislation passing could take longer than normal if it even happens. For TikTok, has had a lot of conversation recently about banning the app altogether, but even then, I find it hard to believe they'll ban it because it's so popular at the moment, and whatever political party or whatever politician decides to ban it, it could be seen as really unpopular especially for the younger crowd, right? For a politician to kind of shoulder that and put that on their resume. In terms of AI regulation, I also think that it's definite possibility, but Congress tends to lag behind technology in terms of passing that legislation. So even though it's very popular right now, we might not see anything for another so and so years. I always think of the self-driving cars and how there's still no legislation really around them, even though they're in development and they might be on the market sooner rather than later. In terms of how the stocks will perform, I think if legislation does pass, there might be a short-term bump in the technology sector, but in the long term, I don't think it'll have any widespread effects. At least that's my 2 cents on it. Alex, do you agree, disagree?
I like your comment about the lag. We're probably looking a year or two. Absolutely. And it's interesting with TikTok, and usually, in this webinars, we don't necessarily comment that much on any individual companies, but I'll say this, other similar platforms, and you know what their names are. Again, I'm not going to mention their names, but chances are they will benefit because again, TikTok, everyone is, focusing on social media, but what really what is really behind it? Well, advertising revenues. That's what's really behind TikTok from the business perspective. And if you have fewer number of users on TikTok, well, presumably they're going to go to other platforms, and well, chances are they will benefit from that. So,
Yep.
Josh, if you don't mind, I'll read a question from the chat box.
Yes, sir.
And then we'll cover that one, and then we'll keep going. So, what do you recommend as a way to avoid having more than the FDIC limit of 250,000 in any one bank? That low amount seems unreasonable without having many different banks. And should we be concerned about larger banks having problems, especially larger regional banks like Truist? So I guess I'll comment on that. There's multiple questions in one. Josh, maybe you'll have comments too. So again, I would absolutely prefer to stay away from making comments or any individual banks. If you're concerned, perhaps you would need to really do more research. In terms of the FDIC limit, and there was this question that I addressed in the chat box earlier. So here how it works. It works by account type. So let's say, well, I'm married, my wife and I, we can actually have up to 750,000 of FDIC coverage. Exactly how would we accomplish that? I would open an account with $250,000. Not that I would necessarily want to do that, but still, my wife would do the same. And then if we also have a joint account, so FDIC would apply to all three separately. Now, make no mistake, if Alex Seleznev has 2 or 3 separate accounts at X, Y, and Z bank, the coverage is only 250,000, because again, that's one of the common misunderstandings. You can make it more complex. You can also set up trusts for that reason. Usually, again, without necessarily focusing on that much, that would not be my recommendation. Now, here's what I would say, and this is my personal opinion. If you're dealing with larger cash balances for personal and business purposes, I would not keep it in one bank. Here's why. Imagine you're in bank X, Y, and Z, and yes, you're fully insured. You wake up one morning, and that bank is all over the news. Exactly how would you feel about it, even if, again, you're protected? So my suggestion, and I'm not saying this would necessarily work for this person, open a brokerage account at one of the national institutions and buy short-term certificates of deposit of up to 250,000. So let's say you have $1 million as an example. You just sold your house and you're looking to buy another one in 3 months or so. You can allocate to, let's say, 5 certificates of deposit with a maturity of 1 month, essentially. So you'll have that FDIC protection, but it's by certificate of deposit because it would be from different banks. The idea, of course, I get this question again. You would open multiple accounts in multiple banks. It is safe, but I understand how it's not the most practical approach. So I get that. Josh, anything to add?
No, I think that was perfect. I tried to avoid any specific scenarios because I really think if you're worried about that, you can go to your bank and they could probably walk you through it. But yeah, I think that's a really great idea with the CD advice for sure. All right. This next question is, what is advice for recent retirees?
Okay, so I guess
comes up sometimes.
This is my bread and butter, right? That's my focus on pre and post retirement. So for recent retirees, I mean, I can come up with a list of different suggestions, but perhaps the most important one is to make sure that you have at least 7 years of your projected cash needs in something liquid and readily available. And again, the question here is, recent retirees, so preferably, you planned for that, so you already have that in place. Why 7 years? Because that just happens to be this average business cycle in the United States. So that's how long it takes for the markets to, decline and then fully recover. So for those who are no longer working, or essentially their only source of revenue or income, I should say, is, let's say, their Social Security and portfolio, it is crucial from our perspective to have that protection of 7 years, in some cases even more, of your projected cash needs. Again, I can say much more, but I would rather just give this short answer. Anything to add, Josh?
That's perfect. That's your bread and butter for a reason, right? Great answer. All right.
We have, well, 6 more minutes, so maybe 2 or 3 more questions. And
Okay.
again, if there anything else, please ask through the chat box. We'll be happy to address it for you.
Absolutely. So this next question said, discuss the Fed interest rates and effect on markets and fixed income investments. Alex, you talked about this a little bit. I can cover in as well.
Please.
So in terms of how rising interest rates affect the fixed income market, it's very simple. Raising interest rates is going to mean the value of your existing bonds goes down. And the reasoning is pretty easy to understand, right? If you have a bond paying 1% and rates increase to 2% and that's suddenly being offered, your bond is not going to be as attractive. So to meet the market value, you're going to have to sell it for a little bit less, right? On the effect on markets as a whole, that's a little more complicated and in economic focused. But generally, and without getting into the details, it's kind of thought of as cooling the economy or putting the brakes on a hotter economy. Consumers are going to save more, which means they invest less, which means they go into markets less. The stock market doesn't like the implications, so typically the stock market goes down typically. It costs more for institutions to fund projects if they have to take out, borrowing costs for any projects that they're working on, and they don't have capital. So as a whole, overall, it's more like a cooling effect on the economy. That's what rising rates does, at least in economic theory. Alex, do you agree?
You summarized it very well, Josh. When interest rates go up or expected to go up, stock markets tend to perform, I don't want to say poorly, but not as well as the opposite when interest rates are going down or expected to decline. And again, I'm emphasizing the idea of expected, because what happens so frequently, something happens and perhaps something big, some kind of major update, but there's no reaction from the markets. That happens more frequently than not, because again, markets are always anticipating that. That's why, again, I shared with you earlier that at this point, we are expecting one additional rate hike. If there are 3 of them, well, I'm inclined to say that the markets are going to be surprised. If there are none, well, perhaps again, that's going to be a positive surprise. So maybe one more question, Josh?
Yeah, we'll make this the last one. Banking crisis versus inflation versus interest rate increases. Where do you think we're heading?
Okay. Do you want me to start, Josh, or do you want to?
Yeah, go ahead.
Okay. So in terms of the banking crisis, and again, I apologize if this is somewhat repetitive. I do believe it's been contained. At least that's the information we have at this point. This is not to say that we're not expecting any additional failures of perhaps smaller banks, but in terms of the largest ones, and usually they track the largest 15 in the U.S., at least based, again, we've been understanding they are safe. Inflation has been declining quite steadily from 9% essentially in June of last year all the way to 5%, which is where we are today. I believe this will continue, perhaps not at a linear pace, and sometimes you think of it, okay, maybe by 1/3% or by 0.5% each month. That doesn't have to be the case. Perhaps it will even go up next month. That, in some sense, is my expectation, because oil prices, increased quite significantly over the past month or so. So you can have those bumps. But our original projection of 3 to 4% by the end of the year, meaning between 3 to 4%, I believe is still in place. In terms of interest rate increases, again, one additional rate hike is the expectation. Some people are, believe that perhaps we'll experience some rate drops later this year. I'm not in that camp. Again, based on the economic data we see today, specifically unemployment rates, other factors too, perhaps in 2024, but not this year. I'm not expecting any rate drops this year. Anything to add, Josh?
I think that's it. And I think that's a good time to wrap everything up.
Absolutely. So as always, thank you everyone for participating. I hope you've learned something new. If there are any questions that you're just not comfortable asking in this format, feel free to reach out to Josh or myself, and we'll be happy to address those questions for you. So thank you.